Okay, the objective of hedging accounting here is to represent in the financial statement the effect of risk management activity that use financial instrument to manage exposure arising from particular risk that could affect the profit or loss. So the purpose of the hedging accounting here is to minimize risk. Here we want to minimize the risk that we discussed previously, maybe the risk because of the exchange, okay, the risk of the exchange rate, okay, and then the other one maybe the risk of the interest rate, okay, and then the other one is maybe because of the risk of the changes in the price, changes in commodity price. Okay, so that is the purpose of hedging accounting. Okay, to hedge hedging accounting here is a technique to recognize gain or loss on the associates, okay, hedging instrument and the hedge items in the P&L. So we're going to have both things here. Okay, we're going to have the hedging item, and then the other ones we're going to have the hedging instrument. So two things that we have. Both items are either going to be transferred in the P&L, the gain or loss that we have here, either we're going to transfer that one to the P&L or others comprehensive income, gain or loss that we have here, either transfer to P&L or transfer it to others comprehensive income. Okay, this is depend on type of hedging that we have. Okay, and then to eliminate the purpose of hedging accounting here is to eliminate or reduce the volatility in the statements of comprehensive income that otherwise could arise in the if the hedge item and hedge instruments are accounted separately. So we have two different things. One is a hedge item, and then the other ones we have hedge instruments. Okay, so what is the hedge item and the hedge instrument? Hedge instrument is a financial asset or financial liability whose fair value of cash flow are expected to offset changes in the fair value or cash flow of the designated hedge item. So hedge instrument here, we expect that the hedge instrument could reduce the risk of hedge item. So we use hedge instruments, okay, to reduce changes in price of hedge items. Okay, and then what is the hedge item? The hedge item is an item that can be recognized. It can be a recognized asset or a liability or unrecognized firm commitment or a forecast transaction or net investment in a foreign operations. Okay, so we have two types here. When we are going to enter the hedging accounting, we need to have these two items, the hedge instrument and also the hedge items. Okay, so the hedge instrument or the hedging instrument here is a derivative, a kinds of derivative. Remember that we already discussed about derivative here. We have a few type of derivative. We have a forward contract, future contract, and then you have the options, you have the swap and the structured note, and then the other ones we have structured note, and then we have embedded derivative. Okay, this derivative here will be measured at a fair value through profit or loss and then may be designated as a hedging instrument. So derivative here is normally will be transfer the value of the derivative here to the profit or loss. Okay, fair value through profit or loss, so means that the hedging instruments here is a short-term instrument. Short-term instrument. Okay, and then for the hedging accounting purpose, only contract with a party external to the reporting entity can be designated as a hedging instrument. So the contract here should be with the external party, only with the external party. You cannot have this one with the internal parties. Okay, a qualifying instrument must be designated in its entirely as a hedging instrument except for, okay, you can accept here, but most of the time we are using for the entire of the hedging instrument. Exceptions here is for the first one you have for the option. Okay, for the options maybe we only want to hedge for the intrinsic value, or we're going to hedge it only for the time value. So remember that for the option we have two elements. Okay, either that one is intrinsic value or the other one is a time value. So we can hedge here either using the intrinsic value or using the time value. Okay, that one is only the exceptions. So most of the time you are using for the entire. Exception here is only given for the options. Okay, and then the other one is about the forward elements. The forward elements, for the forward element, the contract itself can be the hedging instrument, and the spot elements, okay, can be the hedging instrument. So for the forward contract, we have two elements here, okay, and then we have the forwards contract, okay, the forwards elements, and then the forwards spot elements, spot elements and forward elements. Okay, so maybe we can hedge one of these item, the forward element or the spot element. Later I'm going to look at what is a forward element and a spot element. And then the other things that we have here is a proportions of the entire hedging instrument, such as 50% of its nominal amount can be designated as a hedging instrument in the hedging relationship. So for the hedging relationship, the first thing that we need to have here, we're going to have for the whole hedging instrument, entire of hedging instrument. But we have an exceptions. Exceptions here is only for the options, okay, and then we're going to have for the forward contract, and then the last one is a proportion, percentage of hedging instruments. So this is straight in, but most of the time we are referred to this one, we are using the entire of hedge instruments. Okay, and then the other one, we look at the hedge item. The hedge item can be a recognized assets or liability, or unrecognized firm commitment, or also a forecast transaction or net investment in a foreign operation. The hedge item can be a single item or a groups of item. So the hedge items here is either your assets or liability, assets, liability, or others commitments. Okay, and then for the hedge accounting purpose, only assets, liability, or firm commitment or highly probable forecast transaction with the external party. So we only can have the hedge item when we have a transaction with the external party. Entity may designate an item as its entire or a components of the hedge items. So for the hedge item, either that one is entire, or you can have only a parts of. Okay, a parts of. Okay, the same thing for the hedge instruments. Hedging and a hedging relationship, okay, qualify for the hedge accounting only if all of the following criteria are met. Okay, you're going to meet all the following criteria. So for the hedge items here, the hedging relationship only can be exist only when you have the hedge item and hedge instrument. The first criteria, we should have hedge item and hedge instruments. Okay, for the hedging relationship, the hedging relationship only can exist when we have a hedge item and hedge instrument. The second criteria that you need to fulfill here, you should have a contract. Okay, you're going to have a contract for the hedging activities. And then the next one, they're going to have the other things that we have here is the third one is the hedging effectiveness. Okay, so 3 criteria we need to fulfill. For the hedging effectiveness, we need to test. We have to make sure that the changes in the hedge instruments value, okay, divide by changes in the hedge items. Okay, hedge item should equals to 1. Okay, the changes in the price of the hedge item and divide by the changes in the price of hedge instrument divided by the changes in the price of hedge item should equals to 1. Then we consider that one is effective. And then for the hedging relationship only can be exist if you fulfill all these 3 criteria. Okay, the criteria here should have hedge item and hedge instrument, and then we're going to have a contract, and then this contract here is between entity and external party, between entity and external party. Okay, and then the last thing that you need to check here is for the hedge effectiveness. So hedge effectiveness here is the changes in the hedge instrument divided by changes in the hedge item, changes in terms of changes of value. Okay, so I already discussed about the hedge effectiveness requirements. So to check for the hedge effectiveness, hedge effectiveness, you need to compare between the changes in the fair value of the hedge instrument divided by the changes of fair value or cash flow of the hedge items. If you find that the changes in the hedge items or hedge instruments divided by changes in hedge item is less than 1 or more than 1, then it considered as not effective. The hedging is not effective, so it's not fulfill the criteria. Okay, so we're going to proceed with the next slide. Okay, so we have for the hedging positions here, we have two types of hedging position. Okay, the first one we have the long hedge, and then the second one we have the short hedge. Okay, for the long hedge here, the long hedge here is taking a long or buy position in the hedging instrument. So for the long hedge, we have our positions of buying positions here. Okay, why we want to protect, why we want to buy here? Because you want to protect the against of the increase in the price before the actual asset is purchased. Okay, so the long hedge here is we are in the positions of buying the asset, so we want to enter the hedge to protect the increase in price. So this one in the positions of buying, so you want to protect from the increase in price. Increase in price. Okay, the other ones we have a short hedge. Short hedge here is in a selling position. Okay, when we have in a selling positions here, the objective here is to protect investor who plan to sell the asset in the future from the risk of the declining in price. So for the short hedge is based on the selling, so we want to protect from the changes reducing in price. Okay, so we have two type of hedge. Two position of hedge, like the one that you have for the options last time. For the options, you have a call option and then you have a put option. Call option is for buying and to buy, and then put option here is to sell. Same thing for the hedging here. For the hedging, we have long hedge and then short hedge. Okay, for the long hedge here means is we are going to buy, so we are in the positions of going to buy, so you want to protect from the increase in the price. And then for the short hedge is for the purpose of the selling, so we are in the position of sell, so we want to protect from the reducing in the value of the assets. Okay, so for the hedging here, we have three different type of hedging. We have fair value hedging, and then the other one we have a cash flow hedging, and then the other ones we have the hedge of net investment in a foreign operation. This one is when you have a foreign operations. Foreign operation, let's say your company, you are parents, so the parents company here is in Malaysia. Okay, let's say you are company in Malaysia, and then you have a subsidiary or you have a branch in UK. Okay, for example in UK, so for Malaysia they're going to prepare a financial statement in Malaysian ringgit, and then for UK company they're going to prepare that one in a pound sterling. Pound sterling. Okay, they're going to buy that. So once the parents going to prepare the financial statement, they're going to translate. Okay, they need to translate the UK branch, okay, to a Malaysian ringgit. Okay, so this one we're going to look at the hedging of the net instrument in foreign operation, because the changes, there is a changes in the foreign currency, so that's why we're going to hedge for the changes in the foreign exchange. So this one is more on the changes in foreign exchange, in terms of the currency. The currency, so let's say we want to translate from pound sterling to Malaysian ringgit. We want to translate from pound sterling to Malaysian ringgit, the rate will be different. Okay, and let's say the transaction is in September, you want to translate it in December, the rate will be different. So that's why we need to enter the hedging for the foreign operation. So that one is to reduce the changes in the foreign exchange rates. Okay, so we're going to focus on into these two, the fair value and the cash flow hedging. Okay, so the first one we look at the fair value hedging. Okay, for the fair value hedging is a hedge of the exposure to the changes in the fair value of a recognized asset. Okay, changes in the fair value of assets and liability on other or others unrecognized from commitment or any such item that is attributable to a particular risk and which could affect the profit or loss. Yeah, we're going to H. Okay, we want to protect from the changes in, protect changes in fair value of assets or liability. Yeah, okay, the changes in the fair value may arise through changes in the interest rate, okay, changes in the foreign exchange rate, equity price or commodity price. So the purpose of fair value hedging here is we want to protect from the risk of the changes in the fair value of assets and liability. Yeah. Okay, so the accounting treatment for the fair value hedging here. Okay, so the hedge instrument is measured at the fair value, and then if there is any changes here, the changes will be recognized in P&L. So we're going to look at two items. Remember that for the hedging here, we're going to have two items. Okay, for the hedging, we're going to have two items, hedge item and hedge instruments. Yeah, we're going to have both. Okay, said that the hedge instrument is measured at fair value. Okay, and then if there is any changes in a value, changes in value here will be transferred to income statement or P&L. Okay, the carrying amount of the hedge item is also adjusted for the fair value changes attributable to the risk being hedged. The fair value changes is recognized in the P&L. Okay, for the hedge item also there is a changes in the fair value, so any gain or loss here will be transferred to the income statement. To make it simple here, for the fair value hedge, okay, fair value hedge, both changes, okay, both changes in a value of a fair value of hedge item and hedge instruments here will be transferred to P&L or income statements. Yeah? So both changes in the fair value of hedge item or hedge instruments here will be transferred to the P&L. Yeah? Okay, profit and loss accounts. Okay, we try to look at this example. So example 4. Okay, example 4. The M Berhad is a Malaysian company sold goods to S, a company in Singapore. So we have a transaction here between Malaysian company and a Singapore company. Okay, for Singapore dollar of 10,000. Yeah. Okay, for they're going to sell goods, to S company. Yeah. So when you sold goods here, you're going to create the account receivable. So because you sold good, you're going to create the account receivable. Okay, the transaction was on 1st of April. Okay, the transaction here was on 1st of April, okay, 2012, and then the payments going to be received in 30th of September 2012. Okay, account receivable that you can create here, and then payments there going to be received on 30th of September. Yeah, okay, going to be received on 30th of September. Okay, to hedge its exposure to a foreign currency risk, so we're going to have a foreign currency risk here because there is a changes in the Singapore dollar. So to protect this exposure on the risk, M enter into a forward contract with the AA Bank to deliver okay, Singapore dollar 10,000 on 30th September 2012. Okay, the financial year end will be on 31st December. Okay, this is the exchange rate that we have. So we're going to look at here, the contract dates here is on 1st of April, and then you're going to have here the forward contract. Okay, the forward contract that we have here is on this September 2012. Yeah. Okay, the contract here will be on 30th of September, which is the maturity dates. Okay, maturity dates here will be on 30th of September, and then the reporting dates here is on 31st December. So we're going to have a difference rate here Okay, the spot rate is the rate on that date. The rate on 1st of April is 2 ringgit. Okay, 1 Singapore dollar here is equals to 2 ringgit and 20 cents. Yeah. Okay, and then on 30th of September, 1 Singapore dollar is equals to 2 ringgit and 5 cents. And okay, and then you enter the forward contracts here. The forward contract that you enter here, okay, said that you're going to receive 2 ringgit and 10. 1 ringgit of USD, the Singapore dollar here is equals to 2 ringgit and 10. Okay, we're going to look at the journal entry that we have here. Okay, on the 1st April, at the date when you sign a contract, when you're going to sell your items, okay, at this date you're going to sell goods, sell goods to Singapore company, to Singapore company. So when you sell good, then you're going to create an account receivable. So you debit your account receivables and then credit sales, debit account receivables 22 and then credit sales. Okay, the 22 here is from here. The rates during that time here is 2 ringgit and 20. Since M is a Malaysian company, so when they prepare the journal entry, they need to use a Malaysian ringgit. So they need to translate, translate from Singapore dollar to Malaysian ringgit. So Singapore dollar during that time here is 1 ringgit. Okay, 1 Singapore dollar. Okay, Singapore dollar once here is equals to 2 ringgit and 20. So you're going to debit your account receivables 22 and then credit sales of 22. Okay, because the account receivable that you create here is in the Singapore dollar, so you need to translate in a Malaysian because you want to prepare the report from a Malaysian company. Okay, so there is no journal entry to record for a forward contract. So your derivative here, so your each instruments here is a forward contract. Okay, a forward contract. So forward contracts here, we don't have to prepare the journal entry because there is no payment. No journal entry for the forward contract because of what? Because there is no payments, because there is no initial payments, so we don't need to prepare a journal entry. We only need to provide a memorandum to record a forward contract. Just provide a memorandum saying that we just enter the forward contract with the AA Bank. Okay, just enter the forward contract on 1st of April. This is an example on how we're going to write the memo here. Okay, on 1st of April 2012, enter a forward contract. Okay, forward contract with AA Bank, with AA Bank. Okay, so that is only the memo that you need to write here for a forward bank, AA Bank. Okay, and then on 30th September, okay, the 30th September you're going to have a loss here. How are you going to have a loss here? So the loss that we're going to record here, we're going to record both. Okay, because we said that for the fair value here, we need to prepare two journal entry. One is for the H item, and then the other one is for the H instrument. Okay, your H item here is your assets or liability. So in this case, it's your asset because you're going to have your account receivables here. Okay, and then for the H instruments here is a forward contract. Okay, on 30th of September, okay, when it comes to the 30th of September, the rate become 2 ringgit and 5 cents. Okay, the rate become 2 ringgit and 5 cents. So you're going to record for the changes in the value. So your account receivables at the beginning, the value here is 2 ringgit and 20. This one is on 1st of April. When you come to 30th of September, the account receivable value become 2 ringgit and 05. So the difference that you have here is 15 cents. Okay, this 50 cents here is considered as a loss. Why is it a loss here? Because of a reducing in account value of account receivable. So when this is reducing in the value of account receivable, so it's considered as a loss. Okay, as a loss. Okay, so you're going to look at here, debit your foreign exchange loss and then credit your account receivable. Debit here because we have a loss. The amount that we have a loss here is 0.15 cent. That 15 cent times with 10 1000. Yeah? Okay, that is for the H item. Okay, the second journal entries here is to record for the H instrument. We're going to prepare two journal entry. One is for the H item, and then the second journal entry here is for the H instruments. Yeah? Okay, the H instrument that we have here is a forward contract. Okay, the forward contract, when you enter the forward contract, you said that you're going to receive RM2.10 for your account receivable, but now the value of your account receivables here is 2.05, so you're going to receive more. Okay, going to receive more by 5 cents. Okay, why you're going to receive here RM2.10? Because you already enter the contract saying that, okay, on the 30th of September, the value of account receivable should be RM2.10. But in this case, but the actual one, the value here is RM2.05. So means that if the account receivables that you have here has been increased in the value, as your contract here have been increased in the value by 5 cents. So 5 cents here time with 10,000. So you're going to have a 500. This 500 is considered a gain. Why this one is considered a gain? Because your contract price here, so your contract price here is RM2.10, but the actual price of your account receivables here is only RM2.05. So you're going to receive a extra 5 cents. Yeah? So the extra 5 cents here is considered as a gain. So debit your forward contract and then credit gain on forward contract. Yeah, okay, so we're going to proceed with the next one. So on 30th of September here, so 30th of September, you need to close your account receivable. So to close your account receivable, you need to create, okay, this account is a foreign currency account here, is create this account, just create this account to offset your account receivables. Yeah? Okay, account receivables here. Okay, so you're going to credit account receivable 205 here is 10,000 times with RM2.05, 205 here. Okay, account receivables, and then debit your foreign currency. This one is to close your account receivable account. You just close account receivables account. Okay, your account receivable account has a balance of 20,500 at the beginning. Your account receivable has a 22,500. Okay, 22, sorry, and then after that we have reducing by 1,500. So now we're going to have a balance of 2,500. So this account, foreign currency account, is just create to close the account receivable. So we're going to close for the account receivable, so just create this account. Okay, on that date you're going to receive a cash, because this is a payment date. The Singapore company will pay on this date, pay on 30th of September. So they're going to pay here at the price of RM2.10. Why they pay at RM2.10 here? Because of you already enter the forward contract saying that, okay, the forward contract saying that you're going to receive account receivables, okay, receive payment by RM2.10. Okay, so you're going to debit cash, so the amount that you're going to receive based on the forward contract. And the foreign currencies here, you need to close this account because already paid. Close this account and then credit your forward contract. This one also need to be closed here because we already make a payment. So we're going to close this one. They record the settlements of the contract. Receive 21,000 in exchange for 10,000. Okay, because at the price of RM2.10, which is a price, which is the contract that you resign saying that you're going to receive at RM2.10. And then remove your forward contract. Remove your forward contract means that you're going to close the accounts. Yeah. Okay, so this is what you have for example 4. Okay, so we're going to continue with example 5. Okay, for the example 5 here is the example for the fair value hedging. Okay, fair value hedge. Okay, so we have here at the beginning of quarter 1, ABC purchased 50,000 shares of DEF at a price of 5 ringgit per share inclusive of transaction cost. Okay, the investment is held for trading. So held for trading here means that this one is based on the fair value, the fair value. Okay, for a short-term investments. The closing price of DEF okay is 6 ringgit at the end of quarter 1. So you have here, you put it here. Okay, beginning of quarter 1, okay, the value of the shares here is 5 ringgit. Okay, end of quarter 1, okay, the value becomes 6 ringgit. Yeah? Okay, we need to know about this information. Yeah? At the beginning of quarter 2, okay, to protect the value of its investment, ABC purchased 100,000 put options. Put options here is an options to sell. Yeah? Options to sell. Okay, this is option to sell. Okay, so give the right to sell DEF shares at a 6 ringgit per share within 6 months. Okay, you're going to sell that one within 6 months at the price of 6 ringgit. Yeah. Okay, the price paid for the stock options here is 0.47 per unit. 0.47 per unit. The hedge risk is indicated in the market price of this. If the in this case is the market price of the DEF share. So the hedge items that we have here is the shares of DEF. Yeah? Share of DEF. Okay, so you're going to protect from the changes in the market value of shares. Yeah? This is your hedge items. Yeah? Hedge item. Okay, and then the quoted price for the shares and options also follow. Okay, so you have this one. We already mentioned that at the beginning the price is only 5 ringgit. You purchase at the price of 5 ringgit. Okay, and then you said that you're going to sell that one at the price of 6 ringgit. Yeah. Okay, you enter the contract. The contract at this time you are using the option, the derivative that you have here. So for the hedge instruments that you have here is an options. Yeah. Okay. So you have an options. Okay, the price paid for the stock option here is 47 per unit. Yeah? Okay, the hedge risk in this case is the market price of DEF items shares. So this is your hedge item, which is the market price of the shares, and then this is the quoted price of the share. If you look at the quoted price here, the quarter 1 to beginning quarter 1 and the ending quarter 2, quarter 1 there is increase 1 ringgit. Okay, between quarter 1 to quarter 2 there is a reducing by 80 cents. 80 cents. Okay, and then by end of quarter 3 there is an increase by 1 ringgit and 60 cents. If you look at here, there is an increase by 1 ringgit and 60 cents, and then it again increased by 20 cents. 0.20 cents. Okay, look at the options here. Okay, you only have the options at the end of quarter 2. Okay, the price of the options at the beginning of quarter 2, the options value here is 0.47. And then after that it increased to 0.85. So the difference that we have here is what you have here, 5/8 we have here, going to have here is 38 cents. Yeah? Okay, and then it said that in the quarter 3, the option is already expired, because this option here is only for 6 months. So you have to start from the beginning of the quarter 2. Okay, let's say quarter 1 here is from January until March. Okay, quarter 2 you have here is from April until June. Okay, quarter 3 that you have here is from June until September. July from beginning of July until September. And then quarter 4 that you have here is from October until December. So you have 4 quarters here. Okay, so it said that the options, you acquire option during this quarter. Okay, quarter 2, so only for 6 months, so going to be expired at the end of quarter 3. Okay, end of quarter 3. Okay, because the options here is only for 6 months. They're going to be expired. Okay, and then you have another words that are using here, out of money. Out of money here means that when the market value of shares is higher than the option price. So we said that we're going to have out of money. So in this case you have out of money here, because 6 ringgit and 50 cents here. Okay, the 6 ringgit and 50 cents that you have here is the market value. 6 ringgit and 80 is the market value. Compare with the option price here is only 6 ringgit, the option price. So we said that this one is a out of money. So remember that for out of money here, put it here because we already have limited space here. So out of money, okay, out of money here is equals to when the market value of shares is higher than options value. Yeah? Okay, so that is what we have out of money here. Okay, let's try to look at the example. We need to prepare the journal entries here. Okay, for the journal entry solutions here, the first one you need to record for the investments. Yeah? Okay, debit investment in a share DEF at the price of 5 ringgit and then time with 50, so you have 250, and then credit bank. Okay, credit bank here, so you're going to have now the company, the ABC holds the shares. Okay, hold DEF shares. Okay, they owns the shares. Yeah? Okay, now we're going to look at the end of quarter one, end of quarter. So end of quarter, at the beginning when you bought here, the price here is 5 ringgit. This one is at the beginning. Okay, at the end here, the price become 6 ringgit. So the difference that we have here is an increase by 1 ringgit. So when there is an increase, means that you're going to have a gain, and then these gains here will be transferred to your P&L, profit or loss here. Okay, debit your investment. So the value of investment has been increased by 1 ringgit. So 1 ringgit times 50,000 unit of shares. So you have 50, and then credit the fair value gains. The fair value gain is the one that you're going to transfer in your income statements, another 50. Yeah? Okay, that one is to record for the investments only, because during this quarter one there is no hedging activity yet. Okay, no hedging accounting yet. Okay, because you only have the options in quarter 2. Then the quarter 2 you bought our options here, then during this time you have both. Okay, during this time or the quarter 1 you only have the shares. Okay, so means that you don't fulfill the criteria of H item. Okay, your share here is the H items, the items. Yeah, okay, you only have item, you don't have the H instrument. When you come to the quarter 2, then you're going to have the H relationship, because now you have both H item and H instruments. Yeah, okay, starting from quarter 2, then we're going to start for the H accounting, because during this time we fulfill the criteria that we have both H item and H instruments. Yeah. Okay, so the quarter 2, in the quarter 2 here, we're going to prepare the journal entry. Okay, the first journal entries here is to record for the purchase of option. Okay, the first one is to record for the purchase of option, the one that you bought here. The price here is 0.47. Yeah. Okay, debit the put options and then credit the bank. Okay, and then we come to the, this is the first journal entry to record for the H instruments. Yeah, we record H instrument is this one, to purchase of H instrument. So debit the put option and then credit bank. Okay, and then we start to look at here. So remember that we're going to account both. Okay, when you enter, so during this quarter 2 you start to have a H relationship. So when you start the H relationship, you're going to prepare 2 journal entry. One is the changes in the fair value of the H item. So in this case, your H item here is the value, market value of shares. Okay, and then the other ones, you want to prepare a journal entry to record changes in the H fair value of H instrument. Okay, so your H instruments here is the options. Yeah? Okay, so the first one we're going to look at for the changes in the fair value of the H item. Okay, now the share price become 5 ringgit and 20 cents only. So you're going to debit loss here, loss of H item in the P&L. So 80 cent times with 50, so you have 40,000, and then credit investment in share. Why we need to credit here? Because as a reducing in value. Yeah? So we need to credit the investment. Okay, and then this is the first journal entry, and then the second journal entry is for the H instruments. Okay, for the hedge instrument, this is for hedge item. Okay, for the hedge instruments here, going to debit your put options, okay, on DEF shares. Okay, why going to debit here? Because there is a gain. At the beginning, the value here is only 47. This is the beginning of quarter 2, quarter 2, and then the ending of quarter 2, now the value become 85 cents. So there is an increase in value. So when there is an increase in the value, means that you're going to have a gain. So debit your put options and then credit gain on hedge instrument and then transfer it to the P&L. The amount that you have here is 38,000. Okay, 38,000. Okay. Okay, so that is for the amount that you time here is time with the number of options. So you have 100,000. Okay, and then we'll move to the next one for quarter 3. Okay, for quarter 3, you're going to debit investment in the shares because now the value have been increased from 6 ringgit to 6 ringgit and from 5 ringgit and 20 to 6 ringgit and 80. So you're going to debit your investments by the difference that you have here is 1 ringgit and 60 here. So 1 ringgit and 60 time with 50,000. So you're going to have 80,000 and then credit gain on the hedge items. Okay, in the P&L also 80,000. Okay, and then for the options here, if you look at the quarter 3, the options become expired. Expired means that you don't exercise it. Okay, you don't exercise, so the value become, when you don't exercise here, the value here is equals to 0. Okay, so when the value is equal to 0, the previous value at the end of quarter 2, the value of your option here is 85 cents. When it comes to end of quarter 3, because you don't exercise here, the value become 0. So you're going to have a loss of 85 cents. So debit loss on the hedge instrument and then credit your put options here. Okay. Okay, so we move to the next one. Okay, for the next one, for the quarter 4. Okay, the quarter 4 here, you only have the hedge items only. You only have the investments only. So there is no more hedge accountings. Okay, there is no more hedge relationship because we don't have the hedge instruments. Okay, why we don't have the hedge instruments here? Because the options here is already expired. Okay, we already expired, so there is no more hedge instruments, so means that we cannot have the hedge relationship anymore. Okay, because you only have the investments only have your investment. So in quarter 4, debit your investments here, debit here because you have the increase in the value, so now value becomes 7 ringgit. And then the previous value here is ringgit and 80, so you have 20 cent. That 20 cent time is 50, so you have 10,000. So debit your fair value gain and then to the P&L, and then debit your investment, credit the fair value gain. Okay, 10,000 going to be transferred to your income statements also. Okay, so the summaries that you have here. In quarter 3, you have the, in terms of hedge item, you have 300 here. Loss in the P&Ls, you have 40. And then you're going to have a big balance that you have here is 260. And then we come again, you have another loss of 80 gains only. Another gains that you have here is 80. So you're going to have 340. And then for the hedging instrument, so hedging instrument, you start with 47. And then you have a gains of 38, so you have 85, and then 85 after that you got the value becomes 0, so you're going to have negative 85, so it becomes 0 here. So the effect to your P&L here, so this one, the one that you have 40,000 here is because of the price has been reduced from 6 ringgit to 5 ringgit and 20. Okay, you have a loss there by 40 in terms of the instrument. Okay, after that you're going to have the price become, okay, from 5 ringgit and 20 it becomes 6 ringgit and 80. So you're going to have the the increase by 80 here. So the effect to your P&L, so the effect you're going to have both, effect from the gain or loss in the H item and also in H instruments. Okay, if you look at the P&L, the 40 here is come from your H item. Okay, again 38 is come from your H instruments. Okay, and then the 80 here is come from H item, and then another 85 here is come from your loss that you have here is from the H instrument. At the end, the effect to your income segments here is only negative 7,000. That is the effect that we have here. Okay, so that is a okay, so now we continue with the cash flow hedging. Okay, for cash flow hedging here is we're going to hedge as exposure to variety in the cash flow. Okay, going to look at the variety in the cash flow that is attributable to a particular risk associated with all or the components of or recognized assets or liability. Okay, or a highly probable forecast transactions or could be affect the profit and loss. Now we're going to hedge for the cash flow. Hedge for the cash flow. The purpose of cash flow hedge is to defer a gain or loss on the hedging instrument to a periods or a periods in which the hedge expected future cash flow affect the profit. We're going to reduce the risk of the changes in the cash flow. Okay, that is a cash flow. Previously we look at the fair value. The fair value is related with the changes in the market value, but this one is look at the changes in the fair value that are going to affect the profit or loss. Okay, for the cash flow hedging here, so we need to check for the the three criteria: the contract, the hedge item and hedge instrument, and then the effectiveness. Now assume that the hedge is effectiveness. Changes in the fair value of the hedge instrument are initially recognized in the others comprehensive income. This is a difference between cash flow hedge and fair value hedge. Okay, so we have here for the cash flow fair value hedge. Okay, changes in the fair value of hedge instruments transfer to P&L, profit or loss. But for the cash flow hedge, okay, changes in the value of hedge instruments here will be transferred to others comprehensive income. The ineffective portions of the change in the fair value of the hedge instrument, if any, going to be recognized directly in the P&L if we have the ineffectiveness portions here. Okay, for the effective portions going to be transferred to the P&L. The effective portions here will be transferred to the others comprehensive income. So we're going to have two elements here. One is the effective portions. So the effective here we're going to transfer to others comprehensive income. Ineffective portions here transfer to a P&L here. Okay, but most of the time we are assuming that the transaction is effective, the hedging is effective. Okay, for the cash flow hedging, the amount recognized in other comprehensive income should be the lower of the cumulative gain or loss on the hedging instrument from the inceptions of the hedging, and the cumulative change of the fair value, okay, in terms of present value of expected cash flow from on the hedge item from the inceptions of the hedge. We're going to look at the recognize the amount of the hedge cash flow hedging here. We're going to look at the cumulative loss of hedging instrument. Okay, we're going to compare between the loss or gain or loss of hedging instrument, okay, instruments, and then compare with, we're going to compare with, okay, gain or loss from, okay, gain or loss from, okay, from hedge item or hedge items here, item, and then we're going to, okay, going to recognize between these two. We're going to choose the lower, and then transfer it to others comprehensive income. The lower between these two figures, choose between the changes in the value of H instrument, compare with the changes in the value of H item, and then choose the lower, transfer to others comprehensive income. Yeah. Okay, and then for the cash flow hedge is if the cumulative changes in the hedging instrument exceed the changes in the hedge item, sometimes we call this one as a over hedge. So it become in effectiveness will be recognized in P&L. Yeah? If the cumulative change in the hedge instrument is less than the change in the hedge item, sometimes is called as under hedge. There is no ineffective to be recognized. We only recognize here is when the value of hedge instruments is more than the value of hedge items. Then we're going to recognize it in P&L as a hedge ineffectiveness. But if the value of hedge instrument is lower than the hedge item, then we're not going to recognize any effectiveness. So we try to look at this example of the cash flow hedging. September 2019, a light can company anticipate purchasing 1,000 metric tons of aluminium in January 2010. Now you want to purchase. In this case, the aluminium future contract, so you enter a future contract here. Give a lie into aluminium. As a result, they enter a future contract. So the future contract here is your hedge instruments. The hedge items that you have here is an aluminium commodity. This is your hedge item, which is a commodity, price of commodity. In the case of aluminium future contract, give a lie the right and obligation to purchase 1,000 metric tons at the price of 1,550 per tons. They give you a rights to buy at 1,550. So the underlying therefore for this derivative is the price of aluminium. So this is the hedge items. Hedge item here is the price of aluminium. So a light enter into the future contract on September 1st, 2019, and then assume that the price to be paid today for inventory is to be delivered in January. So the aluminium here are going to be delivered in January. So your September 1st of September is your contract date. And then your January next year, January 2020, will be the delivery of the aluminium, or the purchase here. So therefore, on this date, on 1st of deliver in September, the contract dates here. The contract dates, there is no journal entries that you need here because there is no value for the future contract. Means that you only provide a memo here. Provide a memo only because there is no value yet. So no entries here. On December 31st, the price for January delivery of aluminium increased to 1,575 per metric tons. 1,575. December. So you have a few dates here. On 1st of September, this is your contract date or initial recognition date, and then on 31st December here is your reporting date, and then in January here is your maturity date or a settlement date. So now on 1st September, you enter the contract at the price of 1,550. Now the price become 1,575. The price has been increased. The aluminium price increased to 1,575 per metric tons. So when there is an increase the value, so the price increased to 1,575. Now you are in the positions of buying. You enter the contract, you said that you're going to pay at 1,550. So in this case here, because you pay less due to the contract here, so you're going to have a gain. So you're going to have a gain, so your future contract here become your assets. Okay, because of the increase in the price. So debit your future contract and then credit your cash flow hedge reserve and then transfer it to others comprehensive income. The difference here is 25. 25 times with 1000. Okay, Allied going to report the future contract in a balance sheet as a current asset, and the gains here is a part of a others comprehensive income. So we're going to continue with this. Okay, we'll repeat this one once again. Okay, assume that Allied process the aluminium into finished goods, okay, which is a can. The total cost of the cans here, including the purchase on January 2020, is 1.7. Allied sell the can for 2 million, and the record the sales here is as follow. So you're going to debit sales here, okay, the one that you have here, the cash here, and then credit sales revenue. And then for the COGS is 1.7, and then the inventories here is 1.7. Credit the inventory here, because from the can aluminium that reports here, they already produced become a can. Okay, and then since the effect of the anticipated transaction has now affected earning, Allied makes the following entry related to the hedging transaction. Okay, so this is what we have. For the cash flow hedging, we're going to close the account. So we're going to close the account. Previous is you have the credit side. So credit side, now you need to debit. So when you debit here, debit cash flow hedging, hedge reserve to other comprehensive income 25, and then credit your COGS. So credit your COGS here going to affect your earnings here. Okay, so the gains on the future contract which Allied reported as a part of other comprehensive income, now going to reduce your COGS. Going to reduce your COGS because when we sell the inventory, okay, when we sell the inventory, then we need to transfer from gain in the one that you have in others comprehensive income will be transferred to income statements. How are we going to transfer it? By credit the COGS. I'm going to credit the COGS. As a result, the cost of aluminium included in the overall cost of goods sold here is only 155. Okay, how are we going to check this one? Okay, we look at here. Okay, this is with a contract. Okay, with a future contract. So if you look at here, the sales here is 2 millions, and then the COGS that you have here is a 1.7, and then minus 25. So you're going to have a profits of 325. Okay, this is with a future contract. Okay, this one is without future contract. Without a contract here, the sales here is 2 millions, and then the COGS is remain at 1.7. So you're going to have a gain here is only 300,000. So means that by entering the future contracts here, you're going to receive more gains here because the contract has eliminated the increase in the value of the aluminium's inventories here. So by entering here, so for the cash flow hedging here, we're going to transfer the gains that we have from the hedging activity to the income statement when you sell the inventory. When you sell the inventory, then you're going to transfer the gains to the income statement by credit your COGS. So when you credit your COGS here, means that your profit will be increased. Okay, your profit will be increased. Okay, the last one we have hedge on the net investment. Hedging of a currency risk associated with the translations of the net asset of a foreign operation into a parent entity functional currency. For example, here, let's say you have you are Malaysian company, you are parents, okay, and then you have a branch here. Your branch here is in Thailand. Okay, so for Malaysian company, they're going to prepare a financial statement using Malaysian ringgit. Okay, ringgit Malaysia. And then for a Thailand, then you're going to use a baht. Okay, at the end of the year, when they want to prepare the financial statement, they need to translate from baht to Malaysian ringgit. So translate it. When you translate it, we're going to have any gain or loss due to the difference in the changes in the foreign currency, forex, foreign exchange. Okay, but this one is more in the one that you're going to learn about. The translations here is more in 4 semester, 4. So we're not going to discuss detail about this one, on how the net investments here. Okay, so hedging for the net investments here, the accounting treatments here, exchange of difference arising on the liquidations of the net asset and differ in the equity. Okay, changes here going to differ in the equity, means that put it under others comprehensive income until the foreign exploration is disposed or liquidated. So until the foreign is disposed or liquidated, then they're going to recognize in the P&L on the disposal or liquidation as a parts of gain on disposal. This one is more on 4. The foreign currency gain or loss on the hedging instrument are referred in others comprehensive income to the extent that the hedge is effective until the subsidiary is disposed or liquidated, when they become parts of gain or loss on the disposals. Okay, the discontinuing of hedging here, we need to discontinue the hedging when the hedging instruments is expired. So refer back to the example 5, the DEF. Okay, where DEF, when the option is expired. So when the option is expired, we need to discontinue the hedging relationship. Okay, the hedge does no longer meet the criteria of hedging. Remember that the 3 criteria: hedge item you should have, and hedge instruments, and then the other ones we have the contract, and then the last one we should have the hedge effectiveness. So if you do not fulfill at least one of the criteria, do not meet one of the criteria, then you have to discontinue the hedging. The forecast transaction is no longer expected to occur. So this one is for the cash flow hedging. We cannot forecast for the cash flow. Discontinuation of hedging policy apply prospectively, means that only affect in a current year. Okay, and then example for the presentation. So the one that you're going to look at examples here is we focus on the MFRS 7, which is about the disclosure. How we're going to disclose it. Disclosure is required to the user are able to evaluate the significance of the financial instrument for the entity financial positions, evaluate the nature and extent of the risk, okay, arising from financial instrument to which the entity is exposed during the reporting period, and how the entity manage the risk. So this is one thing that we need to disclose. Evaluate the significance of financial instrument and also the nature and extent of risk. Okay, the disclosure requirements include class of financial instruments, significance of financial instrument in the statements of financial position, okay, the effect of financial instrument in their income statement, reclassification, derecognitions and collateral, accounting policy and description regarding hedging accounting, okay, fair value disclosure, qualitative and quantitative, and also sensitivity analysis on the risk that relate with the risk, credit risk, liquidity risk, price risk, market risk, and interest rate risk. So this is example of the presentations, items of financial instrument. You can have a look later on. Okay, so until the end, you just have a look on that one. So this is example of how they present and also how they provide a notes to the account. So